I've never met anyone who doesn't salivate at the thought of having Chipotle for lunch. And what that really does is it speaks to the brand recognition and the goodwill that this company has. And it's crazy that they've sort of owned this burrito market because burrito is a very simple product to make. And yet, anytime anybody that I know wants to go for burritos, it's always Chipotle. And once again, it just speaks to how much of a moat the company has. Now, the interesting thing is, post COVID, we actually relocated to a smaller town just to get away from the city a little bit, get a bigger house. And essentially what we ended up doing is moving away from all the Chipotles in our area. But what's interesting now is that Chipotle, with their next leg of their growth strategy, is now starting to relocate or locate in smaller and smaller towns, as well as grow internationally by striking up some deals. And so the question is Chipotle an interesting enough opportunity to allocate some of our portfolio to? And that's what I'm going to dive into in this video. And so guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. Now, Chipotle is a stock that I've been looking at for many years. In fact, I was looking at it around 10 years ago, and I thought to myself, you know what, this stock seems a little bit too expensive, and then it 4x'd from there. So that tells you everything you need to know about my ability to predict the future as it relates to the burrito industry. But what I do want to show you is what they're doing with their next leg of growth, which I find very interesting. And so in this video, I'm going to show you the news, but I'm also going to show you a model that I built out, which you can get access to, where we sort of analyze where this company is going and what I think its value is, taking all of that into consideration. And so let's dive into this. And so here's the news article. So this came out yesterday where they said that Chipotle is bringing its burritos to small town USA. And essentially what they're trying to do is they have this large growth strategy where they're trying to more than double their store or their retail footprint. And one of the ways that they're going to do that is by going into smaller and smaller towns. And so you're seeing it here that they're looking to build hundreds of locations in smaller markets as part of their overall growth strategy. And thus far in 2023, you can see that Chipotle has been a real winner. They're up almost 60%. So the market really buys in to their growth prospects. But notice that there seems to be a ton of growth implied in their valuation, where the PE ratio is almost 60 times earnings. So the question is, and essentially what I want to do now is 10 years ago, when I looked at the stock and it 4x subsequently to that, what I did was I was, less experienced with investing as I would be, 10 years later, obviously. And I think 10 years from now, I'll be more experienced as well. But what I really did in that time was I looked at the PE and it was somewhere astronomical, where similar to where it is today. And I just thought to myself, you know what, it's too high. It doesn't make sense. However, I didn't actually dig into the story and see if that PE made sense, because a 60 times PE ratio could still be relatively cheap for the company if they're growing fast enough. And so that's what I want to dive into a little bit more. But before we go into the modeling, I just want to round off the story a little bit more. So notice that as of Q1 of this year, they had 3,200 restaurants, and they have a long-term store count target of 7,000 in just North America. That doesn't include the stores that they're going to have or they're expected to have internationally. And I mean, they do have some stores internationally already. And so the stores, the cities that they're looking to go after are cities that have populations of 7,600 to 35,000 people. So this is really Subway territory. And you know what? If you put a Subway up against a Chipotle, I think the Chipotle wins every time. I understand that burritos and subs are different, but as far as I'm concerned, if I'm going for lunch and I have the option between a sub from Subway or a burrito from Chipotle, I'll probably always choose Chipotle. I want to know what you guys think, and let me know in the comments below if that makes sense to you. But notice that they're saying that those are the types of small towns where they hope to open 700 to 800 new locations. So if you think about that, they already have 3,200 locations. So call that 750 divided by 3,200. So 23% of the new footprint is going to come from these small cities. And so that's very interesting. Or actually, they're saying 1/5 of the nearly 3,800 restaurants that the company's committed to is going to come from these small cities. So that's pretty interesting. But the other thing that you got to understand here is that, if they have 3,200 stores right now in North America, and they're looking to get to or grow 3,800 more, that gives you an idea of the growth prospects for the company. And so, you got to think of this from the perspective of two items. You're going to have same store sales growth, plus you're going to have store count growth. And so right off the bat, I can see that there's still a lot of growth here. And the way that I would target it or plan it out is I'd probably give them anywhere to 8 to 10% for store count growth, which is actually the guidance that they provide us. And then I would also have to solve for same store sales growth, and it's that same store sales growth which will allow you to determine if this is cheap or if it's expensive. And I will dive into that concept further in a second, but the other point that I wanted to note for you guys is yesterday they also came out with a press release where they said that domestic growth isn't the only item on the menu. See what I did there? But they're also looking to push for international growth as well. And so they actually signed their first ever development agreement to open restaurants in the Middle East. And so they're initially going to open new restaurants in Dubai and Kuwait in 2024. And then hopefully, that's a success and they'll move forward from there. This absolutely looks delicious, by the way. And so here's what I meant when I said that they actually tell you that they're targeting 8 to 10% growth per year for the stores, and their long-term target is 7,000 locations in North America. So this is good because it helps us model the business out. Now, before we get into the Chipotle model that I built for you guys, I just want to make a quick plug where you can actually get access to the Chipotle model and all the other models that I have on this channel, or companies that I've spoken about on this channel that I said I have models for, at the lower tier of the Patreon. And if you want to join us for a live research call, which I think is absolutely important, you can join us at that higher tier. Okay, and we'll start with the historical numbers because you can see I have 2013 to 2022 here. Now, the first thing that you'll notice is that on their store count CAGR, so I just put certain KPIs here before I started building in the P&L. So up here's some of the KPIs that are relevant. This is typically how I model companies. If there are relevant KPIs that help me forecast revenue, I'll put them above the revenue line. And so you can see here that I have certain KPIs that matter. So I have store locations, and then I have revenue per store. And so you can see that they've 4x'd their revenue per store over the last 10 years, which is absolutely nuts. And of course, their store locations have also doubled over the last 10 years, or at least 9 years. And so what you're seeing is that their store count, they've been growing store count at 8% a year over the last 9 years. And their same store sale CAGR has been around 16 or 17 or 16.5%. And overall, the revenue CAGR, cumulative average growth rate or cumulative annual growth rate is 11.6%. And so you can see that they have delivered strong levels of growth. And so when it comes to forecasting this out, we already know that the store count growth that they're targeting is between 8 to 10%. So we can forecast out 9%. And we know that their long-term store growth target is around 7,000 stores. So, if we're growing this out to around 7,000, we can probably slow down the growth near or just after that. It just depends on how it looks. And then with the same store sale CAGR, I am not comfortable with giving them almost 17% same store growth CAGR, but can I take something at like half that? I think that makes sense. I might be pessimistic in my modeling, but that's kind of how I would want to look at it. Now, the other thing is, notice how their operating profit margins were phenomenal from 2013 to 2015. Then they dropped to single digits between 2016 and 2020. So that was a real tough 5-year stretch for them. And then, of course, they came back up in 2021 and 2022. Now, the question I would like answered before potentially investing in Chipotle is what happened to the margins between 2016 and 2019? Like, we know what happened in 2020, but the question I have is, are the 2021 and the 2022 margins sustainable? If you guys have the answers to that to that question, let me know in the comments below. But that's something that I would like to investigate further before considering investing in this company. And mind you, this is why I really enjoy modeling these companies out, because you can see these types of relationships and you can start asking questions that matter. And so this is how I saw that there could potentially have been an issue between 2016 and 2020. Were they pursuing growth for growth's sake and sacrificing profitability? I'm not really sure. And so that'd be something that I'd be more interested to get an idea of. And of course, the other alternative is that the margins that we see in 2021 and 2022 are not sustainable, and the company goes back to these single digit margins. And so if that's the case, then forecasting it out, we would have to forecast it at that single digit level. So I don't actually know the answer, but it's something very relevant as it comes to forecasting this company's profitability out into the future. Now, when it comes to the forecast, just notice that in North America, I said this to you guys already, but the company operates 3,200 restaurants, and they're targeting 8 to 10% growth just in North America alone. And so they have a long-term target of 7,000 locations. So you'll see that I have 2023 forecasted out, and I go out around 10 years, and you see that I do get to 7,000 locations total for the company, and then I add a little bit more for the international. And so the way that I'm getting there is I'm just forecasting store locations in between that 8 and 10% for the first 8 or so years, and then I drop it down. And I'm forecasting their same store sales growth for the first 5 years at half their traditional rate, or the rate that they've experienced previously. But then I do bring that down in year 5, because even 8% a year is high, especially when you start getting into higher and higher store count. And it's like, I just can't feasibly forecast 8% same-store sales growth a year. So effectively what I'm saying is that I'm forecasting, you put those together, I'm forecasting around 17% revenue growth year over year for the next 5 years, and then 13% thereafter. And I mean, those are high numbers, but I did that on purpose because I want to show that with an even like a bullish revenue estimate, what exactly does the valuation look like? And guys, note that, remember I spoke about the operating profit issue? Well, notice that I'm forecasting out a higher operating profit, so that low double digits. However, when we get the answer to that question about whether the double digit operating profit margins are sustainable, or should we be focusing more on the single digits, that will definitely impact the valuation. And one thing I do want to point out is that this company has a fortress balance sheet. Notice that they have tons of cash. They have, cash equivalent short-term investments and investments in their total asset space, and they have zero debt. Now, the other thing I want you to pay attention to is notice how their treasury stock balance, which is a negative, continues to grow. And this is because they continue to buy back shares with a ton of the cash that they're generating. And so notice that they are shareholder friendly somewhat. And the reason why I said they're somewhat shareholder friendly is I do want you to pay attention to the stock-based compensation line as a percentage of free cash flow. And I just did a simple free cash flow, which is just cash from operating activities minus PP&E. And notice that their stock-based compensation as a percentage of free cash flow is pretty high. Most years it's in that 20% range. So just be careful to not necessarily look at this stock buybacks as a great opportunity or a great shareholder-focused strategy, because a lot of it could more than likely just be them buying back shares that they're allocating or granting to management in the company. Now, there's nothing necessarily wrong with that type of compensation strategy, and it does flow into the P&L as you model out the P&L. So, you are taking it into account. However, it's just something that you should understand if you're going to forecast this company out using free cash flow methods. You do have to deduct or take a position on what you expect stock-based compensation to be into the future, and you have to take a cash charge for it. And I do that with all of my models where I do forecast out using a free cash flow methodology. So it is something that you really have to consider. Now, going into the valuation, despite the anticipated continued success of the franchise, they have a fortress balance sheet, and they're somewhat of a shareholder-friendly management team. I like the fact that they don't have debt, or they're not growing with debt. You see a lot of retailers do that, especially in the food space. So I really appreciate that. I don't see a huge margin of safety in the food space. I don't want to say that I don't see a margin of safety. I want to say that their margin of safety is average. Consumer tastes change, especially over the long term. People will look at Chipotle and be really excited about it today, but will they be as excited about Chipotle 20 years from now? So I wonder about that. I don't know what the answer is. And so, there may be other food outlets that come, but essentially what I'm trying to say is that it's just a burrito. You can get similar burritos in other places. I understand that Chipotle does a really good job, and I do believe that they will continue to do a good job, but I don't see an impenetrable fortress with serving burritos and burrito bowls. And so because of that, I can't give them higher than a 20 times terminal multiple. And I mean, that's high enough as it is, speaking to their future growth prospects. And so when I evaluate the company using the revenue growth rates that I used and the margins that I used that I showed you previously, I'm getting to around $1,400 per share in terms of evaluation. They're currently trading at around $2,200 per share, which reflects a 63.4 times EPS based on the EPS that I'm predicting for 2023, or a 1.58% equity yield. So, I don't necessarily see it as a value. It would have to come way down before it makes sense to me. But I might be very pessimistic on the way that I'm forecasting out the company. And so I want you guys to let me know what I'm thinking about that's right, and what I'm thinking about that I may be missing. And so let me know in the comments below what you think. Now, the company might be a little bit pricey at the moment. However, there's other tools that I can use to potentially enter into a position in Chipotle. And one of those tools is just using a cash secured put. Now, if you guys are not familiar with strategies as it relates to cash secured puts, I recently released a free course on the channel that speaks to cash secured puts, especially in a high interest rate environment. And if you haven't seen that video, you can get access to it right here.